Gold just hit an all-time high this morning. Silver is catching up as well. We're trading over $40 an ounce, and the gold-silver ratio is decreasing. What does it mean? What triggered this price rally and the breakout in the precious metals? I've invited the only guest I could have invited for this topic, David Morgan. He's the silver guru and, of course, the publisher and editor of the Morgan Report. And I couldn't imagine a better guest to discuss the silver breakout. And we'll ask him. What triggered it? Why is it so violent? What is going on? What should we be paying attention to? And what could potentially derail the silver train right now? Lots to discuss. And before I switch over to my guest, hit that like and subscribe button. It means a lot to us. We appreciate any type of feedback. Put it down below in the comments. We read all of it. And we much appreciate it. Thank you so much for doing that. Now, without much further ado, David, it is great to have you back on the show. Very timely to have you on. I hope you had a great summer.
Well, Kai, thank you for the kind, flattering introduction. I hope I can live up to those words. But really, I mean, it boils down to very simply, why are we moving? And it's, as I've said before, and it sounds trite, but it is true. And that is there's more buying pressure than selling pressure. And there's been a rather large short position in the silver market, as there usually is. But we all know that the market is set as a derivative. The price in the futures market, which dictates the spot price and what coin dealers sell their metal for, and et cetera, is determined primarily by algorithms. And so at certain levels, certain things happen. And I have to defer to Michael Oliver, and Michael does momentum. And momentum is very important. Being an engineer, momentum is defined as mass times velocity. So like the whole idea of changing trend with a ship in the ocean, if you have a huge ocean liner, that's a lot of mass. So it's hard to change the direction of it. And the way you do that is slowly. That's how these major trends can change at times. The point being is that the momentum is in our favor. The algorithms are saying buy, and the institutions are buying it mostly for industrial purposes. Yet we do see entities such as Russia that's allocating silver. And you're also seeing on the gold side where China says that their insurance industry can allocate up to 1% in gold. So there's a lot more momentum in a lot of ways in both these markets. And silver, being a smaller market, gets a larger move than gold once the momentum starts.
No, absolutely. Like lots of interesting things to follow up on. I wasn't aware, for example, of the China insurance industry being able to allocate to gold now. But maybe before we get to that, like some of the details here and that are sort of fueling the price rally right now. But we got to talk about it. It feels like there was a trigger in the market just last week that set off the rally here and that brought back the excitement. And it just cannot be just everybody returning back to work today as we record this September 2nd and everybody's excited. There must have been a trigger, David. Did you see anything that could have caused that?
Well, I'll have to be honest and say no, but I will qualify it. First of all, a lot of people think that the news, dictates markets. But if you look at Socioeconomics, a book that Robert Prechter wrote, who's an Elliott Wave guy, and some others, studies have been done independently, several. And really, people have the idea that news drives markets. At times it does, but it's really like 25% of the time. So if you look for a news item like, a breakdown in negotiations or whatever, and that's what drove the market, again, it's buying pressure. Why? We really don't know. My guess would be the idea that the markets were closed in the United States so that the aftermarket or the smaller markets in China, in Asia primarily, a little bit of buying pressure goes a long ways because there's no countervailing forces going on at the same time. Even though markets open in different time zones, the New Yorkers or people in Chicago or wherever can trade in the Globex, so they can be any market at any time if they choose to do so. So I think that really was probably part of it. That's how I would think about it, but am I right or wrong? I think really in the long term doesn't mean a lot. What it does mean is that it doesn't take much buying pressure to move this market. I think it was up over $1 yesterday on September 1st. And the last thing I have to say with tongue in cheek, but this adage goes on for miles, and I put it in almost every report in my April issue, that there's an adage that says sell in May and come back after Labor Day. And believe it or not, that adage holds true very often. And in the April edition of the Morgan Report, I said gold is topped at 3,500 and will remain so throughout the summer and maybe even longer. And so here we are, Labor Day, and it just shoots up. So I'm going to do an update for my premiums members today, later after we're done, talking about here it is. We have proof. It's backing off in the U.S. markets right now somewhat, but it's holding a lot of the gains that it experienced yesterday.
Miners are telling a very different story, though. They were buy in May and maybe sell now because they've been rallying. And we'll get to the miners in a second, but I just wanted to throw that in because they've been performing really well. Physical, gold, not so much in particular. Silver, it's done okay, but the breakout is just happening. Before we get to the miners and other little topics here, $40. How important was that price level to break through? A lot of people have been mentioning, we need to get past $40 so we can rally. I heard the same thing about $30, $34. How important was the $40 level, David?
Round numbers in commodities in general are very important. There's a psychology that goes with it. And so whether we're talking soybean oil, wheat, silver, or whatever, those big numbers are meaningful psychologically. We got $30 silver, now 40, and eventually 50, and maybe 60, 70, who knows? But it's a big deal. And all we need to see really is 3 or 4 closes on close of $40 or better in a row on this kind of volume. And we have a pretty good assurance that the trend is going to continue and that we're going higher. There's not much resistance. There's only, I think I read somebody yesterday, one of my colleagues in the precious metal space talked about, I think it was only about 2.5, 3 months where we've been above 40 on a consistent basis. So we don't have much resistance at all. Very few people that bought at that level are really holding now. I'm sure there's some out there, but from a technical perspective and a psychological perspective going hand in hand, you're seeing, I think, a jump probably to, I expect conservatively at least 10% more by the end of the year, which would put us at 44, and perhaps 20% more, which would put us at 48. Time will tell. Maybe this is going to sell off really quickly and we only get, couple days above 40. I doubt it. I think the momentum is in our favor. It's after, I'm laughing. It's after Labor Day. Historically, we see strength into the final quarter of the year. We're not there yet, but we're getting there. So and the miners, and I want to talk about that quite a bit, but the miners are something that really are assurance that we're in a true bull trend. I want confirmation. I want not only the miners to do well, I want them to do better than the metals. I want to see that 2 or 3x eventually, where they outperform by a factor of, 3x, for example. So if gold moves up 10%, top tier miners are moving up 30%, or if we, that type of thing. And we are starting to see a lot of strength in the miners, as you expressed.
Yeah, lots of strength. I'm just looking at my screen today, and double-digit percentage gains in some of the juniors, actually. The miners are a bit more muted today, in contrast to what I've seen the last weeks, actually, ever since like mid-July and the Q2 earnings, that have really accelerated, I think, the momentum here in the miners. And maybe we'll stay on that topic for a second. I want to, jumping around too much. I'm trying to connect it. But on the miner side, like what triggered that rally, that outperformance as well? I've mentioned before the Q2 earnings felt like an extra fuel to the fire, especially on the bigger miners. Is that something that you're watching that is starting to trickle down now?
It is. It's, I've been in this market more than 40 years and I'm still learning. And historically, the miners will usually lead the metal. And I say usually because, and that's a tip off for somebody that's, studied these markets. Like, these gold stocks are moving, but nothing's happened in gold. We're probably going to see a rally here. Well, that did not take place this time. The opposite occurred. We saw the metals, especially gold, take off, and the miners were lagging. And I think it has to do with a lot of things. But one of them is that the market is much more sophisticated, a lot more computer trading, a lot of algorithms out there that do the trading. And the other thing is the value investors still look at one thing primarily, and that's earnings. Now, the earnings in the gold stocks have been phenomenal, but it hasn't equated into the price of those companies because many of these companies are trading as if gold is at 2,000 the ounce when it's been at, roughly 33 to 3,400 for 4 months in a row consolidating. And that information is now going where? Into the algorithm, into a trading desk, into a hedge fund manager, into the general public, into a whatever, pension fund. And wherever it goes, that knowledge is saying, hey, I'm a value investor. This is a real value play. This stock has got to eventually catch up to the earnings that it is providing that we know we have. And so that is what I think fueled the rally in the gold mining industry. Silver lagging, but silver actually is a smaller market, as we know. There are very few pure silver plays. If any, there's really one silver stock I could think of that's more or less pure silver play. The rest are silver plays, but they have, lead or zinc or copper or gold or something combination thereof. They're still silver stocks, but they get a bigger margin than gold. For example, at the top of the market previously, we saw a PE of a top tier gold company sell at like 30 PE, but an equivalent silver company would sell at a 50 PE. Well, why? Well, silver is more volatile, and I guess it's more loved at the top of a market than gold is.
I'm not finding it in the comps table. I was curious where we're at in terms of valuations for the major miners, but also some of the smaller producers. Like, where do you think we're at right now? Do you have an overview?
I don't. I know we're below that, I think, in some instances. I do want to make a caveat here because a PE is not a very good metric for a mining company. I mean, there's a couple big books back there that are hard slogs, and valuing a mining company is much more about free cash flow than it is a PE. PE is useful at the top of the market to get an exit strategy. Can be used, but it really isn't like a retail store selling, women's clothing or, grocery store, what have you. It's not a good metric for a mining company, but people use it. There's nothing against it, but it really isn't the best metric. So I just want to get that into the record because, that's what we do primarily at the Morgan Report is analyze mining companies, not just gold and silver, but, lithium, cobalt, the rare earth elements, the battery metals, you name it, copper. I'm becoming much more bullish on copper than I was, let's say, 6 months ago. So there's a lot happening in the resource sector. And one of the best leveraged plays you can do with lower risk, not no risk, is in the mining equities. And if you start with blue chips and work your way down into a speculative section where you basically make the correct bets, meaning how much money you allocate to each tier, you can do quite well and have a balanced risk to reward profile.
Yeah, our audience is probably getting tired of me saying it, David, but I've been harping the Newmont horn lately because I'm not a big fan of the company itself, but it's the second best performing stock in the S&P 500 and nobody's talking about it.
Yep.
All right, it's only being bested by Palantir, and let me just look at the updated one here. So Newmont is up 104.5% year to date. Palantir 106.6. We're closing the gap. Last week there was a 14% gap between Palantir and Newmont. Give it 2 days, Newmont will be the best performing stock in the S&P 500, and nobody's talking about it. It's mind blowing. So I'm not worried that we're in any type of euphoria phase. Like, would you agree with that?
Yeah, and I have to digress if you allow me. I mean, in 1979, Hecla Mining, which is right over there, I could drive to in an hour, their office, and the Lucky Friday Mine, was the best performing stock on the entire NYSE. It went from $5 to $50 in 1 year. And so I put Hecla Mining in the Morgan Report in the early days, like year 2 or 3 of publication. And that stock was at about 50 cents, and it was in danger of being delisted because there's certain rules for an NYSE stock they have to abide by. That stock went from 50 cents to $5, a 10-bagger, the same exact metric it did in 1979 when it was published all over the financial press as being the best performing stock. I gave that lecture in Calgary at an oil meeting, oil and precious metals. and said, here we are, a 10 bagger. My readers know about it. I'm asking them to cash out at this level. And nobody even knew the word Hecla mine. So it goes back to what you said. No one was paying attention. And that, I think, is a very good, clear, clean indicator for everybody listening to this that the bull market is far from over, in my opinion, because, again, who's paying attention? Not very many.
No, like that's the question, maybe, David, as well, to follow up on. Like, where's the money now coming from? Is it just us mining investors and speculators that are sending the same $20 bill around? Or is there actually new money coming in that is helping us reach these levels?
It's both. Primarily, well, first of all, let's talk about the metals and the miners. So in the metals, it's almost all institutional buying on both sides, gold and silver. As far as the equities are concerned, it's a few sophisticated buyers, like some of the best known names in the hedge fund industry are nibbling at the miners, the top tiers like the Newmonts. But it's mostly retail coming back into the market, and higher prices. Cure for low prices is low prices. Yeah, it's so true though. And now they're making a move, and again, no one's really paying attention yet. And we've yet to see anything close to the top of the market, which means there's that manic buying. And that, in my view, is probably a couple of years away. But we will start to see more and more interest in these, both from the retail and institutional side.
That's the question. Like, where is the money coming from? Meaning, like, institutionals, they have to chase returns. Sadly, and I've mentioned that on the show before. We closed the gap, or we closed the dip of the Liberation Day, or people call it the Trump slump. Back in April. I was being a bit nasty, hoping that we would stay at 4,800 for the year at least on the S&P 500, because I was thinking, my mentality was like, well, it might make the 401k money move, right, into different sectors, chase returns, which they could potentially get in the mining space. Like, very naively thinking, very egocentric, of course, because a lot of my portfolio is in the mining space. But are we seeing that yet? Like, I don't think, yeah.
Yeah, we are. There's I should have bookmarked them because I love to give credit to other people because you should. Can't remember. There's a couple guys out of the United Kingdom, and they do analytical work on strategy and rotation. And the rotation has started into the commodity sector through the equity side, meaning your ADMs for food, for an example, or the mining for the commodity sector and minerals. And it's a subtle but measurable shift that is taking place. So, like going back to the ship turning, momentum changing, it's very subtle at first. You don't really notice that this big ship with all that mass, and the trend is so big and it's got so much momentum. It's very hard to move and change direction, but it is starting to change direction. And that's provable, at least by the metrics that these two gentlemen use. And I see it by the amount of interest in our work and the kind of calls that we're getting, where we're seeing people that were, let's say, bigger investors that have probably participated in this massive bull trend in the S&P 500 for a long, long time, looking to diversify, looking to maybe hedge, looking for what the next sector will be. And I see it, I feel it, and it is measurable.
No. How much is left on the table here, David, when you look at performance? Like, I don't want you to give like investment advice. Hey, we're 200% from the top, but I'm trying to understand, like, how much room is there left for the miners to run? What is your prediction before we get talking more about some of the granular details that you mentioned in your intro?
Well, from my work and others, it looks to me as if we're in the final leg up in a major bull market. And I went and, as you know, we talked about it before we started recording, and I wanted to verify, my work with Elliott Wave, and I did so, and it said, I had it correct that wave 3 up. There's 5 waves in Elliott. It's usually the strongest and most dynamic move in the sequence. It's where the leg prices cover the largest distance in the shortest amount of time compared to the other waves. It often has the heaviest trading volume. It tends to be the longest and most powerful wave, though not always. is driven by a big shift in market psychology, which we just discussed, disbelief from earlier stages, followed by recognition and enthusiasm as more participants jump in. So since I think we're in the beginning of that leg, we're seeing more and more participants jump in, but we still have a fair ways to go, meaning that retail that's given up on silver, maybe not silver stocks, but very few retail investors that bought even in the 30s are buying in at 40. It's like, I've broken even or I'm slightly ahead. Let's see how far it goes. But institutions need it, or industrial users need it. And so that's fueling the market. I think the Asian markets are more involved than they were in the past, although silver is not nearly as bought on a retail level in the Asian markets as gold is. Regardless, we're seeing that momentum change. And I do think that we're going to see, as it says, probably the most dynamic move in price appreciation in this last leg up. And again, where does it go? I'll say probably a couple more years. And just to be sincere, I have said, we got a couple years left, more than once, and probably as long as 5 years ago, and I was wrong. But, whenever you stick your neck out, it can be chopped off. But the facts are backing me up now. There was a false start, I believe, in 2016. I can, talk about that. I don't want to, but there were times when it looked like we were going to break into the next leg up, and it really didn't carry through. This time, it's obvious. Gold is well above the 2000 breakout level. It's $1,300, $1,400, $1,500 above that. Almost not quite a double, but from 2000 to 3,500 is quite a move. And it sustained it, and we're breaking out of that consolidation. Remains to be determined if it's a breakout or fake out. We have a couple more days to watch. But no, it's exciting times.
What could derail the train right now, the silver and the gold train, David? Like, I'm trying to come up with bear cases, and I've mentioned in other interviews, I'm having a very hard time. Maybe the jobs report in the U.S. is way more positive than everybody believes, although nobody believes in the jobs numbers anymore. But what is a bear case here?
Well, the bear case is given by Avi Loeb. You can look him up. He is a really good Elliott guy. It sounds like I'm a big Elliott Wave guy. I'm not. I've studied at a very cursory level. This man has dedicated most of his life to studying Elliott, and he's very good at it. But he gave a lecture at the New Orleans conference, the 50th year anniversary of the New Orleans Gold Show, which is one of the most well-recognized and strongest and best gold shows in the world. And he spoke right after the opener, Brian London, about where gold is going. He said it's going to 3,500, and that's it. And he sees a multiple-year bear market after that, and he sees a strong case for the dollar going up. So he's definitely a contrarian. And he doesn't go into the fundamentals, but after listening to him, I came home and really thought about it, because I like to look at both sides as well. And I thought, well, what fundamentally would cause that? And the fundamental case is if we get into a liquidity crisis where people just can't afford groceries, can't afford have to choose between the electric bill and the grocery bill. And we're seeing that. And so what you do is you start to see money become more valuable to the average person or harder to get. And so they start to sell off whatever they have. Not that the average American has gold or silver. They do not. The point being is that if we start to go into a deflationary push, we could see these markets cool off. That would be the main fundamental reason that you could see it. And I need to explain that a little more, Kai, if just allow me, because I wrote about it in the Morgan Report a few months back. And I explained to people that if the S&P got cut in half, for example, then that ounce of gold would buy twice as much stock, twice as many businesses as it does now, without the price of gold changing whatsoever. So the way you need to look at it is not what the paper price of gold is, but what is the value? Meaning how many barrels of oil, how many used cars, how many houses, how much stock does this buy? So I said, for example, if we saw a 5,000 factor on the major index and a $5,000 gold price, which isn't that far from 3,500, that would be a 1-to-1 ratio using that ratio. And is that unreasonable if we have a big liquidation where a lot of people that have their 401ks or whatever, stock market starts to come down rapidly, they don't get out in time, they've seen a great deal of their wealth evaporate. So that is a deflationary situation that could, I'm not saying would, but could take place. So that's the fundamental case that I wrote about, not saying it will happen, but as one of my favorite quotes, you've heard me say it before, chance favors the prepared mind. So if I were to see the market tell me, not my thoughts, not Avi's thoughts, actually manifest in the market where I saw this taking place, obviously I'd put out an alert to my people and say, buy puts, liquidate part, take some profits. I'm not in favor of like shooting the moon and saying, hey, I called the top, or I believe this is the top, unless I'm certain, which is almost impossible. But if the market's telling me things have changed, that ship is, going the other direction or whatever, or a thunderstorm hit it as a metaphor, you've got to take action. The worst thing that beginner investors do is a round trip. They buy a stock at 10, they watch it go to 80, then they hold it all the way back down to 10. Never do that. You want to protect your profits. And that's one of my main functions for my membership, is to make sure we protect profits.
No, absolutely. Although the message should be buy the dip, David. Always buy the dip. It's always a dip. No, I'm joking, of course.
Always buy the dip in a bull market. It's just, but averaging down will wipe you out better than anything else. I mean, it's not a good strategy in most cases.
True. Let's shift momentum here real quick. Platinum metals, or platinum. I know I've seen you post about it on X just the last 24 hours quite extensively, David. Very different topic. What are your thoughts on platinum?
Well, we were early on platinum, and we were writing about it in the Morgan Report again and again and again. And I said in the April letter, gold's topped out at 3,500 at least through the summer. And if you have new funds or you want to add to your positions, buy silver or platinum. And that was President call. I mean, it was like almost not to the day, but it was very close. And so anyone that bought at that time was up, 30, 40, 50% perhaps. There aren't too many platinum miners. I reviewed a few on a verbal update. I do these videos for the members. And but I like it. How much further it has to go remains to be determined. I think it's going to consolidate here for a while. But it's something that you should buy if you've already got gold and silver. I mean, platinum is not nearly as liquid, and it's a super small market, but you pay a price in the physical market on the buy and the sell. You pay a huge premium on the way in, and you have to take a discount on the way out. So you got to know that and be prepared for that. But it is very much a unique metal, and it's being used more in the quote unquote hydrogen economy, which most people don't even know about. But primarily in Asia, there's been a push, not a huge one. I don't make a big case about it, but people are seeing the discrepancy between platinum being at one time when it was $1,000 and gold 3,500 of a 3-to-1 ratio. I mean, it's 1/3 the price of gold, and yet it usually sells at a premium to gold because depending on the stats, it's about 15 times rarer than gold. That why not buy platinum jewelry? Gold is going to cost me this much. I can get this platinum necklace that's 3 times the size for the same money, or what have you. So there is a push into platinum, but not a big one. But again, with a small market, it doesn't take much new buying to force the price higher.
And everybody's got gold already, it seems like. So let's diversify a little bit. No, awesome. David, it was great to catch up with you. It was great to have you back on the show. Obvious question, and I'm not sure if our audience doesn't already know where to find you, but just in case, where can we send them?
Let's go to themorganreport.com, and all our connections are at the top right of the website. Icon for our Twitter feed, icon for our YouTube channel, icon for our LinkedIn presence. And then if you want to see the trailer for the documentary, it's at silversunrise.tv.
Fantastic. David, thank you so much for joining us. It's always great to catch up, and we'll have to check in maybe later this year, give a bit of a forecast. What do you expect for 2026, of course? So we'll check in with you again and everybody else. Thanks so much for tuning in to Soar Financially. Silver's broken out. Gold is breaking out at all-time highs. Newmont is about to reach the top spot in the S&P 500 as we speak. So lots going on, and lots of good news from the precious metals front. But as David said, hedge your bets. Look at other opportunities. Maybe diversify. Lots of good opportunities out there. The miners are just starting to run, and it's still early days. Third leg, as he said, in an Elliott Wave. Really curious what you think as well. How are you positioned? Let us know down below, and good luck out there. Have fun, and be safe. Take care.